So let's again touch on the challenges. Number one, we search for tools. As we search for tools, it is imperative that we understand what the indicators measure and what the output is, because that is what allows us to actually efficiently use the indicators. And then as a challenge we also have, we are considered retail traders. We don't get to see everything that's going on behind the scenes. We don't get to see levels. There's a lot of information that's missing to us. So we're always trading against the algos, against the machines. So what's the best we can do? The best we can do is try to ascertain the movement of the market, jump in and get out in time so we don't get affected by a reversal. With the markets and cycles, there's something that is basically, I believe we all know, and that is Dow theory, where Dow theory talks about major cycles, intermediate cycles, and minor cycles. Each cycle is smaller in nature. The challenges also is ascertaining momentum. So with that, we have a number of indicators. And momentum is like when you have an automobile and it's sitting in your front yard and it's at zero. No, it's just at a standstill. And then it accelerates. And when it accelerates, it goes from, let's say, 0 to 60 in 6.2 seconds. That's a push, a momentum change. Now, the rate at which it continues is velocity. In other words, you keep on with the same amount of pressure on the accelerator. And as more energy is being added, the momentum original that you started with, it continues to drive with the acceleration in essence, price movement. There are times then when finally velocity wanes because of the momentum that the instrument has. It continues moving, let's say, upward in a bullish bias or in a bearish bias. And we're going to look at all those things as we go along. And the third part of the trader challenge is understanding what is taking place. Because you look, I mean, over here we have a market profile. We have a MACD. We're looking at time and sales, the transactions that are taking place in the market. We're looking at level 2. At what level do we have a certain amount of offers, bid, and asks? You know, what will someone sell us a specific instrument, you know, a contract for the NASDAQ or for the ES or for the YM? And that fight is taking place all along. So that is the internal market force that we want to look at. So let's recap. We want to measure market direction, bias. By measuring bias and by looking at internal market forces, we're trying to ascertain trader sentiment. Then there's the blending of cycles. And what I mean by blending of cycles is when we create an analysis, we do not rely solely on, let's say, cycle force. We look at that and we say, okay, let's look internally what's happening in the market. And then we ascertain market force. By combining two different types of measures from different perspectives, we are attempting to gain or to provide an edge. And an edge is that which allows us on our analysis to make a better, deeper analysis that will have a higher probability of success.